Few words in investing sound as off-putting as junk bonds. The name suggests something worthless. The reality is one of the largest parts of the global bond market, held by pension funds, insurers, and professional investors. So what are junk bonds, also called high-yield bonds? Why do experienced investors hold something with such an unflattering name? And the real question, are they worth the risk? In this video, we'll walk through what high-yield bonds actually are, how credit ratings draw the line between high-yield bonds and investment-grade bonds, why investors choose to hold them, the risks involved, and how individual investors in Europe can access them today. The information in this video is for informational purposes only and does not constitute investment advice. Always do your own research or consult a financial advisor before making investment decisions. So, what are junk bonds? A junk bond, more formally called a high-yield bond, is a corporate bond issued by a company with a lower credit rating, which pays a higher coupon to compensate investors for taking on more risk. That's the whole idea in one sentence: more income in exchange for more risk. The name has a history. Before the 1970s, lower-rated bonds were mostly so-called fallen angels, companies that had been downgraded after their finances weakened. The investment banker Michael Milken popularized the idea that companies without an investment-grade rating could issue new debt at higher coupons and still find buyers. The label junk bonds stuck, even as the market grew into one of the largest segments of global fixed income. One thing to keep in mind from the start is that fixed income investments still carry risks, including the risk of partial or total capital loss. Where exactly is the line drawn? It comes down to credit ratings, and three agencies dominate this: Moody's, S&P Global, and Fitch Ratings. A bond rated BBB- or above by S&P and Fitch, or Baa3 or above by Moody's, is considered investment grade. Anything below that threshold is classified as high yield, the category referred to as junk. A rating reflects an agency's view of how likely the issuer is to keep paying. Higher ratings generally indicate lower expected default risk, while lower ratings generally indicate higher risk, which is why those issuers typically pay more. The catch? Ratings aren't fixed, and they aren't guarantees. An issuer rated BB today might be upgraded toward investment grade or downgraded further. That begs the question, why would anyone choose a bond labeled junk? Despite the name, high-yield bonds attract a broad range of investors, and it comes down to a few things that are hard to find elsewhere in fixed income. The first is income. High-yield bonds typically pay higher coupons than investment-grade bonds. Say, for example, a company issues a bond with an 8% annual coupon, compared with around 3% on a government bond generally considered lower risk. On 5,000 euros, that's a meaningful difference in the income you may receive each year. But that difference in potential income is the market's way of pricing in extra risk. Higher potential returns generally come with higher investment risk. The second reason is diversification. Because high-yield bonds tend to behave differently from both equities and investment-grade bonds, adding some to a portfolio can change its overall risk and return profile. And the third is duration. Many high-yield bonds are issued with shorter maturities, which can make them less sensitive to interest rate moves than longer-dated bonds. You understand the appeal, but high-yield bonds pay more precisely because they carry more risk. So it's worth being clear about what those risks are. The main one is default risk, the chance the issuer can't make its coupon payments or repay your capital at maturity. There's also liquidity risk, because high-yield bonds can be harder to sell than investment-grade bonds, particularly when markets are under stress. Rising interest rates can push up borrowing costs for issuers and weaken their finances. And a downgrade can trigger forced selling by institutions, pushing prices down regardless of whether the issuer's actual situation has changed. None of this makes high-yield bonds unsuitable. It just means the higher income comes with conditions worth understanding before you invest. So how does an individual investor in Europe actually buy high-yield corporate bonds? For most of the bond market's history, this was difficult. Minimum investment sizes were high and issuance was concentrated in institutional channels. That has changed. Regulated investment platforms have lowered the barriers, making it possible to invest in individual high-yield bonds with smaller amounts and clearer information than before. If you're considering adding any high-yield bond to your investment portfolio, it's worth asking yourself a few questions. Can this issuer realistically keep paying me? How does this fit alongside the rest of what I hold? What happens if I need to sell before maturity? And does the higher income actually match the level of risk I'm comfortable with? There's no universal answer. Income-focused investors may lean into high-yield bonds, while someone focused on protecting their capital may keep their exposure small or skip them entirely. If you're ready to explore high-yield bonds yourself, Mintos gives European investors access to high-yield corporate bonds from €50 on a platform licensed by the Bank of Latvia. You can hand-pick individual bonds or use automated portfolios, if suitable, and exit early through the secondary market if needed, subject to demand. Which side of the trade-off speaks to you more, the higher income or the lower risk? Drop a comment and let us know. If this video helped you understand high-yield bonds better, give it a like. And if you're ready to start building a portfolio that includes them, check out Mintos and see what fits your goals. Thanks for watching. Here's to smarter, more confident investing.